Hello everyone, and welcome back to the channel. Today, we're taking a deep dive into the future and unpacking what the US stock market might have in store for us in 2026. This isn't about a crystal ball. It's about piecing together the economic puzzle using data and insights from leading financial institutions. So, if you're planning your long-term investment strategy, you'll want to stick around for this. Let's start with the big picture. What major forces will be steering the market in 2026? It really boils down to three interconnected themes. First, and most importantly, is monetary policy. After years of the Federal Reserve keeping things tight to fight inflation, the consensus is pointing towards a shift. We're expecting the Fed to begin an easing cycle, which means they'll likely start cutting interest rates. This is a huge deal. High rates have been a major headwind for stocks, so a move in the other direction could provide a powerful tailwind, especially for growth-oriented companies that are sensitive to borrowing costs. The second major force is the overall economic environment. Projections from organizations like the IMF suggest that we'll see moderate, steady growth in the US. Think of it as a Goldilocks scenario, not too hot to reignite inflation, but not too cold to trigger a recession. This kind of stable backdrop is generally good for corporate profits, even if it doesn't mean we'll see a runaway economic boom. Inflation should continue its slow journey back down, which reinforces the case for the Fed to ease up on policy. And that brings us to our third theme, a laser focus on earnings and productivity. With overall economic growth being moderate, just riding the wave won't be enough. The markets will heavily reward companies that can expand their profit margins. How will they do that? Through productivity gains. This is where technologies like automation and artificial intelligence become critical. Companies that successfully use AI to become more efficient, cut costs, and gain market share will be the real standouts. It's a shift from a market driven purely by macro trends to one where individual company performance, their execution is paramount. So, what does this all mean for the stock market as a whole? Most analysts are forecasting positive returns for major indices like the S&P 500 in 2026. But the key word here is uneven. The exact outcome will depend heavily on how quickly the Fed cuts rates and how well companies deliver on their earnings promises. Under a positive scenario where the Fed eases and earnings are strong, some strategists see the S&P 500 hitting new highs with high single-digit or even double-digit annual returns. However, we should expect a lot of variation. The winners could win big, while other parts of the market might just trade sideways. This won't be a market where a rising tide lifts all boats equally. This leads us to the most exciting part. Which sectors are poised to win and which might lag behind? The clearest potential winners are in big tech and the entire AI ecosystem. The massive spending on AI models, advanced semiconductors, and cloud computing isn't slowing down. The dominant platform and chip companies have powerful, long-term revenue streams and the ability to scale efficiently. They're at the heart of the productivity boom we just talked about. Beyond just the tech giants, look for companies that are the enablers of this new economy. This includes software firms with recurring revenue models and industrial companies that specialize in automation and robotics. They are selling the tools that other businesses need to become more productive. And as a hedge against all this tech risk, many institutional investors are still looking at gold. It is often seen as a safe haven and can act as a good portfolio diversifier when things get volatile. On the other side of the coin, who might struggle? The biggest risks are for companies with weak balance sheets and a lot of debt, especially smaller firms. If the Fed doesn't cut rates as quickly as the market hopes, the cost of that debt will remain a heavy burden. We could also see some consumer discretionary stocks lag. Think about companies that sell big-ticket items that often require financing. If real incomes don't keep pace or consumer confidence wavers, people will pull back on those kinds of purchases. Of course, no forecast is complete without considering the risks. What could derail this positive outlook? The biggest risk is a disappointment from the Fed. If inflation proves sticky and the Fed has to delay its rate cuts, or if the cuts are smaller than expected, it could cause stock valuations to shrink, hitting those high-flying growth stocks the hardest. Another major risk is an earnings recession. So much optimism is priced into a small group of tech leaders. If they fail to deliver on revenue or margin expectations, the market reaction could be swift and severe. And finally, we can never ignore geopolitics. Any major shock to global trade or a spike in energy prices would increase uncertainty and send investors flocking to safer assets. But let's not forget the upside. What could make 2026 an even better year than expected? The bull case centers on AI-driven productivity gains happening faster and wider than anyone anticipated. If companies across many different sectors start seeing significant margin expansion thanks to AI, it could fuel a much broader market rally. Combine that with a smooth and decisive easing cycle from the Fed, and you have the recipe for a very strong year for equities. So, how should you position your portfolio for this environment? The core of your strategy should probably remain a diversified exposure to U.S. large-cap stocks. However, you might consider overweighting high-quality growth companies that are clear beneficiaries of the AI and cloud trends. At the same time, be nimble. You need to be ready to rotate into more cyclical sectors like financials, industrials, or materials if we get confirmation of strong economic growth. Risk management will also be key. With volatility expected, consider using tools like options or defined outcome ETFs to hedge your bets, especially if you have a lot of exposure to a few individual stocks. A barbell strategy could also be effective. On one side, you have your quality growth names, and on the other, you have value-oriented, cash-generating cyclical stocks. This is more nuanced than simply betting everything on growth. Let's quickly walk through 3 possible scenarios for 2026, the Bazi-Kazi, and the most likely is that we see moderate growth and the Fed delivers 2 or 3 rate cuts. In this world, the S&P 500 posts positive returns, tech and AI continue to lead, and we see occasional bouts of volatility, especially around earnings season. The bull case is that AI supercharges productivity, earnings come in way ahead of expectations, and the Fed cuts rates several times. This would likely trigger a broad market rally with strong participation from many sectors. The bear case is that inflation remains stubbornly high, forcing the Fed to stay on the sidelines, or a geopolitical shock rattles the markets. In this scenario, rate cuts are delayed, many sectors would struggle, and investors would rush into defensive assets and commodities. So, to wrap it all up, what should a prudent investor expect from 2026? Expect a stock picker's market. The headline indices can certainly move higher, but the real money will be made by identifying the specific companies that can turn investments in technology and AI into real, durable profit growth. The key principles for success will be diversification, selective exposure to the AI leaders, a readiness to rotate when the macro picture shifts, and disciplined risk management. It's shaping up to be a year of increased opportunity, but also increased dispersion between the winners and the losers. Thank you so much for watching. I hope this detailed outlook helps you prepare your investment strategy for the years ahead. If you found this analysis valuable, please hit that like button, and don't forget to subscribe for more deep dives into the markets. See you in the next video.